Most people think investing begins with choosing a stock, but investing does not begin with a stock. It begins with a much bigger question. How does money move through the economy? Every day, households save, firms need capital, governments borrow, institutions manage wealth. Investors accept risk, avoid risk, transfer risk, and try to earn returns for the future. Behind every stock price, every bond yield, every fund, every portfolio, and every market headline, there is a system that connects savings to investment, a system that turns real assets into financial claims, a system that prices risk, reveals information, creates liquidity, and helps capital flow toward different opportunities. So in this lecture, we are not just going to list investment choices. We are going to step back and understand the investment universe itself. By the end, stocks, bonds, cash, real estate, alternatives, derivatives, portfolios, and investors will no longer look like separate pieces. They will look like parts of one connected financial world. Let's begin with a basic question. Why do financial markets exist? They exist because not everyone in the economy has the same timing of cash flows, the same opportunities, the same tolerance for risk, or the same need for liquidity. Some households, firms, governments, and institutions have funds available today. Others have productive uses for capital today. Financial markets connect these groups. A financial market is a system where financial claims are issued, bought, sold, priced, and transferred. These markets move capital from suppliers of funds to users of funds, but they do more than move money. They help investors trade existing claims, manage risk, compare opportunities, and observe prices. Financial markets support capital formation, capital allocation, risk transfer, liquidity, price discovery, information production, and governance. However, markets are not magic. They do not eliminate uncertainty. They do not guarantee perfect outcomes. Instead, they provide a structure for processing information, pricing risk, and reallocating capital. The quality of that structure depends on transparency, regulation, competition, contract enforcement, liquidity, and incentives. So, as we study investments, remember this central idea. Markets are not just places where assets trade. They are systems that connect savings, risk, information, and real economic decisions. Now let's distinguish between primary markets and secondary markets. Primary markets are where new securities are issued. When a firm, government, or other issuer sells a new financial claim, the issuer receives capital from investors. This is why primary markets are directly connected to capital formation. They help organizations raise funds for investment, operations, refinancing, and growth. Secondary markets are different. They are where existing securities trade among investors. When investors trade an already outstanding security with each other, the original issuer usually does not receive new capital from that trade. Even so, secondary markets are extremely important. They provide liquidity, meaning investors have a better chance of converting financial assets into cash when needed. They provide price discovery, because trading activity reveals information, expectations, and required returns. They also give investors flexibility. Investors can adjust portfolios as their needs, expectations, or risk tolerance change. Primary and secondary markets are closely connected. Investors are more willing to buy new securities if they believe they can later sell them at reasonably fair prices. A deep and liquid secondary market can therefore make it easier and less costly for issuers to raise funds in the primary market. This connection helps explain how savings become real investment. Investors may buy a financial claim, while the issuer uses the proceeds to acquire real assets, expand capacity, or finance productive activity. The investor owns the claim. The issuer uses the capital. The economy gains a mechanism for transforming savings into investment. The next major concept is capital allocation. Capital allocation is the process of deciding where scarce financial resources should be invested. This happens at several levels. Inside firms, managers allocate capital among projects, products, divisions, acquisitions, technology, working capital, and risk management activities. Inside investor portfolios, investors allocate wealth among asset classes, securities, managers, countries, currencies, and strategies. Across the economy, financial markets influence which firms, industries, governments, and projects receive funding, and at what required return. The central trade-off is simple in words. Capital should go to opportunities whose expected benefits justify their risks and opportunity costs. The formula shown in the background expresses this idea more formally, but the intuition is what matters. Investors require compensation for committing capital. The required return reflects both the time value of money and the risk investors must bear. The risk premium is not the same for all assets. It depends on the type of risk, the amount of risk, and how much investors dislike that risk. Assets with greater exposure to important risks generally need to offer higher expected returns to attract capital. This is why capital allocation is both a valuation problem and a governance problem. Investors ask whether expected returns are adequate. Managers ask whether projects earn more than the capital they consume. Boards, creditors, regulators, and beneficiaries may all influence the decision. Good capital allocation is not just about choosing what looks attractive. It is about asking whether the expected reward is sufficient for the risk, the opportunity cost, and the purpose of the capital. Let's now separate real assets from financial assets. Real assets are productive assets. They help create goods, services, or operating capacity. They include land, buildings, equipment, factories, technology, patents, infrastructure, natural resources, and human capital. Real assets are the foundation of productive capacity in the economy. Financial assets are different. They are claims on cash flows, ownership, repayment, or contractual payoffs. They include stocks, bonds, loans, deposits, fund shares, derivatives, and other financial contracts. A financial asset is an asset to the investor. From the issuer's perspective, it may be a liability, an ownership claim, or another contractual obligation. This distinction matters because real assets help generate economic value, while financial assets distribute claims on that value. A share of stock is valuable because investors expect the firm to generate future cash flows from its assets, strategy, and competitive position. A bond is valuable because investors expect the issuer to make promised payments. A derivative is valuable because its payoff depends on something else, such as an asset price, rate, index, or event. Portfolio managers usually invest in financial assets, but the performance of those assets ultimately depends on real economic activity, contractual terms, market prices, and investor expectations. So when we analyze any investment, we should look beneath the label. What real economic activity supports it? What cash flows does it claim? What risks does it transfer? And what expectations are embedded in its price? Now we move to the major asset classes. An asset class is a broad group of investments with similar economic exposures, contractual features, risk drivers, and market behavior. Asset classes help investors organize the investment universe before selecting specific securities or managers. Let us begin with cash and money market instruments. These are short-term, relatively liquid investments. They are often used for liquidity management, collateral, emergency reserves, transaction needs, and temporary investment of funds. Their main advantages are liquidity and relatively low price volatility. But cash is not riskless in every sense. Its purchasing power can decline when inflation is higher than the yield earned. Also, some instruments that look cash-like may still involve credit risk, liquidity risk, or operational risk. Next is fixed income. Fixed income securities are debt instruments. The issuer borrows money and promises to make payments according to the contract. The payments may be fixed, floating, inflation-linked, amortizing, or conditional on specific terms. Important fixed income concepts include principal, coupon, maturity, yield, credit risk, and interest rate risk. The bond valuation formula shown in the background captures the basic present value logic, but actual bond valuation can be affected by contract details, taxes, embedded options, default risk, liquidity, and settlement conventions. The key idea is this: fixed income is not just about receiving payments. It is about understanding the reliability, timing, risk, and value of those promised payments. Let's continue with public equity. Equity represents an ownership claim. Common shareholders usually have residual claims on the firm's cash flows after contractual obligations have been satisfied. That word residual is important. Equity investors are exposed to business performance, financial leverage, competitive dynamics, managerial decisions, and investor expectations. Unlike most debt contracts, common stock generally does not promise fixed payments. Dividends may be changed, suspended, or omitted. Much of an equity investor's return may come from price appreciation, which depends on expectations about future cash flows and valuation. The valuation expression in the background summarizes the central logic. Equity value depends on expected future cash flows to equity, timing, risk, and required returns. Equity markets matter for managers because they affect the cost of equity capital, investor expectations, executive incentives, takeover pressure, and the firm's ability to issue shares or use shares in acquisitions. Now, beyond cash, bonds, and stocks, investors may also use real estate, commodities, currencies, and derivatives. Real estate may provide income, appreciation potential, inflation exposure, and diversification, but it can involve illiquidity, leverage, local market risk, operating costs, taxes, regulation, and valuation uncertainty. Commodities provide exposure to physical goods such as energy, metals, and agricultural products. Currencies expose investors to exchange rate movements. Derivatives are contracts whose values depend on an underlying asset, rate, index, event, or variable. They can hedge risk, create exposure, change payoff patterns, or support speculation. But derivatives require careful attention to contract design, margin, collateral, liquidity, counterparty risk, and model risk. Alternative investments are another important part of the investment universe. The phrase alternative investments is used in different ways. It often refers to investments outside traditional public equity, public fixed income, and cash. Examples include hedge funds, private equity, venture capital, private credit, infrastructure, real assets, and some derivatives-based strategies. Private and alternative investments may provide access to different risk exposures, less liquid markets, specialized manager skill, leverage, and investment structures not easily available in public markets. But they also bring important challenges. Valuations may be model-based or appraisal-based rather than continuously observed in public markets. Investments may be illiquid with limited exit opportunities. Fees and incentive arrangements may be complex. Risk may be difficult to measure because return histories can be short, smoothed, or strategy-specific. Governance, transparency, and operational due diligence become especially important. The better question is not whether an investment is traditional or alternative. The better questions are, what risks does it add? What cash flows or exposures does it provide? How is it valued? How liquid is it? What fees are paid? And what role does it play in the portfolio? That last question is essential. Asset classes are often included because they serve different portfolio roles. Some support liquidity, some generate income, some seek growth, some provide inflation sensitivity, some improve diversification, some help manage risk. The same asset class can play different roles for different investors. Therefore, investment analysis should always connect the asset to the purpose of the portfolio. Investors rarely evaluate assets in isolation. The relevant question is often how an asset affects the risk and return of the entire portfolio. A portfolio is a combination of positions. Each position has a weight, and each contributes to overall return and risk. Portfolio risk is not simply the weighted average of individual asset risks. It also depends on how asset returns move together. This is where covariance and correlation become central. In plain language, diversification works best when the portfolio combines assets with different risk drivers. The benefit does not come merely from owning many securities. It comes from owning exposures that are not all tied to the same shocks. Diversification can reduce asset-specific risk, also called idiosyncratic risk. For example, a portfolio concentrated in a single company or industry can be vulnerable to events specific to that company or industry. Adding assets with different economic drivers may reduce that concentration. However, diversification does not remove all risk. investors may still face broad market risk, interest rate risk, inflation risk, liquidity risk, credit risk, geopolitical risk, and economic cycle risk. So the main lesson is this: portfolio construction is about relationships. An investment that looks risky by itself may still improve a portfolio if it behaves differently from the rest of the holdings. And an investment that looks safe by itself may be problematic if it increases exposure to a risk the investor already has. Now, let's consider the investors themselves. Individual investors invest on behalf of themselves, their families, or closely held entities. Their decisions are shaped by personal goals, risk tolerance, taxes, employment income, liquidity needs, time horizon, financial knowledge, behavior, and legal constraints. Common individual objectives include retirement funding, education funding, home purchases, emergency reserves, charitable giving, wealth transfer, and lifestyle spending. These goals may have different horizons and risk tolerances. That means a household may need more than one investment pool. Important considerations include human capital, taxes, liquidity, behavior, and concentration risk. Human capital is the value of future labor income. It can be a major asset, but it may be uncertain and may be connected to industry or market conditions. Taxes matter because different account types may affect where assets should be held. Liquidity matters because households face unexpected expenses. Behavior matters because overconfidence, loss aversion, attention to recent performance, and poor timing decisions can damage outcomes. Concentration risk matters when a household has too much exposure to one employer, business, property, or asset. Institutional investors are different. They manage capital on behalf of beneficiaries, clients, policyholders, donors, governments, or owners. Examples include pension funds, mutual funds, exchange-traded funds, insurance companies, banks, endowments, foundations, sovereign wealth funds, hedge funds, private equity funds, private credit funds, and family offices. Institutions often face formal mandates, governance structures, reporting requirements, legal duties, liquidity rules, risk limits, benchmarks, and delegated management relationships. Individual and institutional investors may use the same securities, but suitability depends on objectives, constraints, liquidity needs, risk capacity, and decision-making structure. Let's bring everything together with the investment process. The investment process is a disciplined sequence of decisions for translating objectives into portfolio actions. It is not only about selecting securities. Security selection matters, but it should occur inside a broader framework. A sound process begins by defining objectives. What is the purpose of the capital? What return is needed? What risks are acceptable? What horizon matters? How will success be judged? Then the investor identifies constraints. These may include liquidity needs, taxes, legal restrictions, spending needs, liabilities, governance, ethical limits, and policy requirements. Next, the investor defines the investable universe, develops capital market expectations, sets strategic asset allocation, selects securities or managers, implements trades, and then monitors, rebalances, and evaluates outcomes. Strategic asset allocation is especially important because it determines the portfolio's broad exposure to equity risk, interest rate risk, credit risk, inflation risk, liquidity risk, and other systematic drivers. Implementation turns the policy allocation into actual investments. This includes decisions about active versus passive management, public versus private markets, direct securities versus pooled vehicles, hedged versus unhedged currency exposure, and internal versus external management. Passive investing generally seeks to track a benchmark efficiently. Active investing seeks to add value through judgment, skill, discipline, information processing, risk management, access, or specialized expertise. A benchmark provides a reference point for evaluating risk and performance. Finally, investment policy and governance give the process structure. A good policy clarifies objectives, constraints, permitted investments, risk limits, benchmarks, rebalancing rules, liquidity needs, and responsibilities. Markets are not just numbers on a screen. They influence decisions by firms, investors, households, and governments. The investment universe is a connected system of real assets, financial claims, investors, contracts, markets, prices, risk, information, and governance. Thank you for joining me today. I'll see you in the next video.